like this. This is an industry sector, the airline industry. It's a truly awful sector from an investment standpoint. This is 20 years, so that's 1994 to 2014. I didn't choose them because they suit me. It's pretty typical of the airline industry. I didn't come up with the numbers on this chart. They came from the Airline Industry Trade Association, IATA. And as you can see on this chart, there's their cost of capital, this thing that I mentioned earlier. You can see this red squiggly line. It's a guess. I think if you average that line, it comes out at about 8.5%. Frankly, it doesn't matter in terms of judging whether these are good or bad businesses. So their cost of funds, if you like, is 8.5%. But like them borrowing from this bank at 8.5%. These are their actual returns on capital, these nice grey bars here, and there's the scale over there. You can see it goes up and down a bit. It never once gets to the cost of capital. This is a machine for losing money, basically. If you average those bars, it comes to about 3.5%. So it's 8.5% cost, 3.5% return, so they make on average negative 5% returns per annum. And if you read the report this is based on, you would see that the airline industry during this period had an average capital employed in the world of about $500 billion US. So they lost 5% of $500 billion for their investors collectively per annum. It's amazing. And it's a really bad industry. Now, I know when I speak to any audience, there'll be some of you in the audience who will think, maybe even say in the question session, well, you can't be right, because if you were right, airlines would cease to exist. Not while you keep sending them money to recapitalize them, they won't. They go bust, they're still flying around. You can go down to the airport and you can go and fly on an American Airlines flight or a Canadair flight or a Swiss flight. All of these airlines went bust and were immediately recapitalized shorn of their liabilities. They weren't out of the air for even a nanosecond, basically. I always say competing in the airline industry must be like the financial equivalent of one of those horror movies like Night of the Killer Zombies. Because even if you run your airline pretty well, your competition keeps going bust and then reappearing again without any liabilities. It must be terrifying. You know, I think in the last month, 8 airlines have gone bust in Europe. Last month? Mark knows more about airlines than I do. It's a really terrible industry. Now, if you have fund managers who are investing in airlines on your behalf, and trust me, you will have people who are investing in airlines, and you say, Mr. Smith said airlines are a really terrible sector, why are you invested in them? There are a couple of things that are likely to be said. One would be they won't have a clue what we're talking about. They won't have read Warren Buffett's 1979 annual report. They don't know about return on capital employed. It's never entered their head. But even if they have got some grasp of this, they'll say, you see, I'm pretty smart. They'll say, I buy it when the returns are down there, and I sell it when they're up there, and then I buy it back down when they come down here, and then I sell it when it goes up there. And there's only one problem with that. Or 2 problems with it. One is I've never actually met anyone who can do that. Because, you know, you don't know when the returns fall down there, whether that's the bottom. You know? You don't know whether they get up there, whether that's the top. There's no announcement. So, you know, you invariably end up getting your timing a bit wrong. The other thing is this. Think back to this return on capital employed versus cost of funds. You buy your airline stock and you say, well, look, it's pretty depressed down here at the moment. There's a recession going on, and I think it's all going to bounce back. And I think there'll be some airline consolidation. I think some of them will be taken over and so on. Or there'll be a change of management, or the oil price is going to drop, or all of the above will happen, and I'm going to make money, right? Whilst you're sitting waiting for these events to occur, this thing is steadily eroding in value. It's the investment equivalent of trying to carry around a melting ice cube in your hand in terms of trying to realize your gains, right? This is what a good company looks like. And you can see, I mean, I've been using these slides for many years. That's why 2014 is the final year. I don't need to change my examples an awful lot in life, I find. Bad sectors and companies are bad, good ones are good. Doesn't change an awful lot, frankly. This is Unilever, a fast-moving consumer goods company, which I'm sure you've heard of. This is a decade. It's a very typical decade. There's its cost of capital. You might wonder why the cost of capital is down here on this chart, where it's up there on the other chart. The answer is you've got to have it down there in order to get these bars on the scale, right? This is a company that makes, as you can see, about a 20% return on capital, basically. And its cost of capital, if you average that line, is about the same as the airline industry, allegedly, about 8 or 9%, basically. This makes money and grows in value steadily year by year by year. Now, you can get Unilever wrong. We all get things wrong. I get things wrong. If you buy Unilever when its returns are there in 2008 and it has a really bad 2009 because of the global economy, you probably don't feel too clever about your particular timing of your purchase. But how the company grows in value will dig you out. Whereas in the airline, how the company shrinks in value will bury you.